everybody, this is Brandon Cobb with HBG Capital. Thanks for tuning in, and in today's video, I want to give an overview of our entire investment thesis here at HBG Capital. When we first started out, we were all over the board. We were doing deals in different states across the country. We were doing a lot of house flipping. We were doing some onesie-twosie new construction. We were doing a lot of wholesaling, buying, holding, renting. And when we really drilled down and figured out what we were good at, which was new construction, we just focused strictly on that asset class. And as we focused on that asset class and started to scale, we really had that pending thought of 2008, 2009 in the back of our minds. My job, what I try to do is surround myself with people who've been doing real estate for as long as I've been alive. Guys who've been in 3, 4, 5 market cycles. Try to understand what those market cycles were like. How did people perform? What did they do? Those who survived, what did they do? And then those who thrived and did really well, what did they do? And so what evolved from a lot of this networking and a lot of these sit-down discussions from these people who've been around a long time was our whole philosophy of buying these recession-resistant assets. And so once we focused on what our niche was, and we felt very confident that these types of assets are going to do really well, basically when there's an inverse correlation with how the overall economy is doing. That's what we want. All types of real estate do well when the economy's booming. Right now, it feels a lot like 2005, 2006. Lending's very loose. There's a lot of money available. You've got hard money lenders knocking on everybody's door. They're marketing. It's super loose right now. Maybe not in like the banking world. The banking, I do feel like there is still the right regulations in place. It's not like super easy to get a bank loan like it was back in 2007, 2008, and prior to that. I talked with one guy who said that, they'd just give you a 100% loan. They didn't really care about the assets, as long as the deal looked good. And it was crazy back then. It was like the wild, wild west. Not quite like that. But what I really did listen to was what continued to perform well despite the economy. And spec builders got hit really, really hard back in 2008 and 2009. And, we do a lot of spec. We were doing some land development. And that's scary, right? Because what I don't want to do is I don't want to repeat the same mistakes that other people have made. So how do I go about doing that and developing that understanding? And this is how our recession-resistant returns backed by real assets evolved. And so I want to kind of break that down. HBG Capital has 2 arms. One is a new construction arm where we focus on new construction acquisitions here in Middle Tennessee. And the other arm is a commercial acquisition arm where we focus on commercial acquisitions, specifically across the United States in the market that we feel meets that investment thesis. And I'll kind of touch base on that here in a little bit. But I want to break down each arm of the business. And the reason why we're in 2 different classes is we want diversification. Last year, COVID, a lot of the commercial got hit pretty hard, but it's bounced back. 2008, 2009, residential got hit pretty hard, but it bounced back. So we want to make sure that we're evenly diversified in case whatever happens, we're ready to weather that storm. So from the new construction acquisition arm, there's a couple ways that we can look at things, but I want to try to break it down as simple as possible. I'm going to start from a high-level overview and then boil it down to a microscopic view and how we're managing risk. Everything we do is underwritten with risk in mind. So I'm going to start with some of these bigger, high-level buffers, if you will. When I say buffer, I'm talking about resistance to recessions and how that's going to impact the Middle Tennessee market. And then as we drill down, I'm going to explain how we get a lot more focused in choosing these assets and why that focus amplifies the recession resistance. So from a high level, we chose Middle Tennessee because it's still very affordable compared to the rest of the country. And it's a great place to live. Detroit, affordable. Not a great place to live. You don't hear about a lot of people moving to Detroit, but you can get some great deals on some houses. I think back in like 2010, they're almost giving away houses just to get people in there and paying the taxes. So we chose Middle Tennessee because it is a great place to live and it is still very affordable compared to the rest of the country. This is why if you go out in Nashville, for example, 1 out of every 10 people you meet is probably not from Nashville. There's tons of people moving out here from California. There's a ton of people moving out here from the northern states, especially New York. It has just become this very popular area to live. And so that's one of the reasons why we like it, is for that attractiveness. The second is the no income taxes. So like Florida, Tennessee does not have a state income tax. So businesses want to move here. Businesses are moving in droves, again, from California, New York, a lot of those northern states, a lot of those heavily taxed states, because this is a safe haven and people want to thrive. If you tax people to death, they're going to look for somewhere else to live. And so that makes Middle Tennessee even more attractive. Now, let's get on a local level. If you look at what a lot of the politicians are doing here locally, they're actually incentivizing businesses even more to move here with tax breaks. You've seen all the skyscrapers going up downtown. I mean, it's just crazy how many businesses are moving here. It seems like every time I open up a local Nashville business magazine, there's some big company that's moving here. You know, Amazon's building a business downtown. Oracle's moving here. You've got tons of fantastic companies that are moving their headquarters here, and it's creating jobs. You create jobs, you create growth, you create a great economy. And so that's the third high level reason why we like Middle Tennessee. So let's drill down a little bit more into how can we further insulate ourselves against a recession. So back in 2008, back in 2009, a lot of spec builders got hit really hard. The first ones that got hit, that took the topple, were these higher priced custom homes. Whenever you have a change in the market, the first tier that gets hit are your custom, semi-custom homes, your $1 million, your multi-million-dollar homes. That's the first thing that gets hit, and that's what we track. So we track the average days on market for all the higher priced stuff because they're the canary in the coal mine. When we see those average days on market starting to trend up with those classes, we know, okay, something's kind of up here. And then that'll trickle down. It'll hit your mid-level stuff, you know, your 500, 750,000, depending on where you live. And then it'll trickle down your 300, 400, $500,000 homes. And then that last class that gets affected is really your affordable housing, right? And so that's where we like to thrive. It's all about supply and demand. Right now, there is no supply of affordable housing in Middle Tennessee. It is just completely dried up, and there's huge demand for it. And basically right now, we feel if there was some crazy event like COVID last year, we still feel that because of the supply and the high demand for homes, that asset class is not going to get hit. If you look back in 2008, 2009, people still need homes. No matter what the economy does, people still need a place to live. Our population's increasing. No matter what the economy is, it's still going up at an astronomical rate, and people still need housing. So when you have a recession, that need doesn't go away. The need's still there. People just pivot from a higher asset class that's more expensive into lower, into lower, into lower. This is why you hear like assets like, you know, mobile home parks and storage units, part of our other arm that I'll get to here in a minute. Those historically perform really well because people are pushing into those asset classes. So that's what we focus on here in Middle Tennessee is, you know, most of the stuff that we're building here in Davidson County and in the outskirts and the suburbs are really focused on those first-time home buyers. It's affordable and it's low supply, high demand. So let's take it even further. What our firm does is in Middle Tennessee, we're completely turnkey, and we want it that way because it minimizes risk and it minimizes market exposure. Like I was explaining, the biggest risk the biggest reason that spec builders got hit back in 2008, 2009 was they were taking so long to build the homes. When you take 12 months to build a home and the market's coming down, you are going to have market exposure, and that's a huge risk. We don't want that risk. So what we did was we created HBG Construction. We are the general contractor. We're licensed to build subdivisions, anything that we pretty much want aside from doing commercial ground up here. We don't do ground up commercial in Middle Tennessee. But the reason we did that was the builder's incentive was directly aligned with our investors. So whereas our competitors might do the same thing, raise capital and deploy it into deals, they have to hire a builder. And all of a sudden, their firm's performance and the investor's capital's performance is completely dependent on how that builder does. And historically, the construction industry is an industry that doesn't have like the best rap. It hasn't caught up with the Amazons of the world and delivering just world-class service. And so we knew that that was a big risk. So that's why we created our own in-house construction company. We manage everything in-house. So where it takes a builder could, if you hired a builder out, they could bite off more business, they could chew, service slips, they could go bankrupt, they could decide to retire. If any of those things happen, it affects the entire performance of your business, which is a huge problem. We did not want that problem. So whereas it's taken 8, 9, 10, 12 months for people to build houses here, it's taken us on average 6 months or less to build these homes. What that does is it limits the market exposure. So if we do have some kind of big event, you don't have, it's not like the stock market that can jump down 30% in a month, right? The real estate business is more like a battleship. It takes a little bit longer to turn, but when it does turn, it does turn. Well, if we can get in and out of these assets relatively quickly, we limit our market exposure, and we limit the risk, and we limit the risk that the investor's capital is going to be safe. So that's what we do. That's the reason why we manage everything turnkey from top to bottom here in Middle Tennessee, and some of the high-level reasons why we feel Middle Tennessee is a very recession-resistant market with the certain variables that I've laid out. So that's the new construction side of things. So what else does HBG Capital invest in? Well, HBG Capital invests in multifamily acquisitions. We invest in assisted living facilities. We invest in storage units. We invest in mobile home parks. And I'll briefly touch base on each of those and explain why we do that. So again, the whole model is written on recession-resistant returns backed by real assets. And based on what I've told you a little bit earlier, Class B, Class C multifamily is in that same class. It's affordable housing, but it's not in like the war zone area. So we really like that blue collar worker class, very affordable housing with value add potential. So when something does happen and people are losing their jobs and the economy's bad and the monetary supply is constricted, people pivot into these Class B and Class C assets at an alarmingly high rate, and we like that, right? They perform well. There's an inverse correlation in the market and how these assets perform. That's what we want. We also invest in storage units, and traditionally storage units are a great asset that weathers any kind of recession storm. Now, there is more competition these days. There's a lot more capability to build. If you can find the land and build these storage units, there's a little risk that there could be some competition, but right now there's really low supply. And the reason these do well is, again, in recessions, people have to move. When people are moving, they're usually using a storage unit. I've personally used the storage unit every single time that I've moved. And so there's a huge need for that. You've got the baby boomer generation that's 77 years old. The oldest baby boomer is 77, so they're getting to the age where they're wanting to downsize. They're wanting a smaller home, but they got all this stuff. What do you do with all that stuff? You put it in a storage unit. So there's a huge need for these storage units, and traditionally they do really well when the market does turn. We also invest in assisted living facilities for some of the same reasons. Again, the baby boomer generation is 77. They're getting old. They're getting dementia. They're getting Alzheimer's. They need to be in a place that has that memory care service, and they need to be somewhere where they can be taken care of. Now, this is different than nursing homes. Nursing homes where you need severe health care assistance because they're having health complications. No. This is assisted living. They're still very independent, but the siblings might not be able to give them what the parents need based on their condition. So you've got 10,000 baby boomers that are like retiring a day, some of the younger ones, and they are really they need somewhere to be able to park their mom and dad, right? Mom and dad are getting old. They want to take care of them. There's been a huge need for these facilities because in the past, these assisted living facilities kind of have a bad rap, and for good reason. The management traditionally was very poor. They didn't do a very good job of treating, their clients that were in the place. Like if you ask your grandparents, like, hey, what do you think about going to a home? Like, they freak out, right? Because that's the rap that it's had. They've had a bad taste in their mouth. It's not today the same case. Today you've got these Class A, beautiful, almost resort style homes that look fantastic. And it's changed the perspective a lot. These are no longer the places you want to avoid putting your parents. They're actually pretty good places to go. And they've got very high level care service that mom and dad need to get them in there. So this has made it very attractive. There's a very good runway because so many baby boomers are needing this type of service. There's a just huge runway for these types of assets if you can get your hands on them. The big boys are playing in this market, so you have a lot of real estate investment trusts, a lot of REITs that want these assets in their portfolio because they're predicting this is going to just perform every single other real estate asset out there over the next 20 years. I think I saw some article. We're getting older. We're living a lot longer, and I think by 2040, like 1 out of every 3 people is going to be over the age of 65. I mean, that's crazy. So we're going to have a very, very big growing older population. So that's why we like these assisted living facilities. Mobile home parks, beating a dead horse here, but again, it's the same concept. You've got affordable housing. Everybody pivots into those more affordable classes whenever you've got some kind of economic cycle, and so these mobile home parks they make for fantastic deals. On top of that, a lot of times banks don't like them, so what that does is it opens up opportunities when you purchase a mobile home park to get owner financing from it. The conversation with the owners usually goes something along the lines of, "Hey, Mr. Owner, I can't get a bank loan for what I want to pay you for this. I want to give you what it's worth. But the bank over here just doesn't agree with us. How about we work something out with ourselves? I'll pay you X amount of dollars per month, and we'll do a 30-year loan, just like we'll make you the bank on it. And when we pay you off, we pay you off. If you can get your terms, the price you pay doesn't matter. We put a commercial property under contract, and we currently own it, and we paid them. I think it was almost double what the property was probably worth at the time, but we were paying them I think it was $1,000 a month, and it rents out for $2,400 a month. And I mean, it's just all cash flow after that in an area that's rapidly appreciating. They're bulldozing all the other commercial assets. They're building stuff around this. I mean, we know that this is going to be a completely different area by the time we pay this loan off. So it's cash flow, and we didn't put any money down on it. So it was great, and that's what we do with these mobile home parks. It's the exact same thing. We want to owner finance them, have them cash flow, lots and lots of equity for our investors in those deals. That's the stuff we really like. All right, that's it for today. If you enjoyed this conversation, I want to have a two-way conversation with you. Go to hbgcapital.net, send us a message. We'd love to set up an introductory call. If you've ever been curious about investing in recession-resistant assets, we'd love to see if we might be a fit for you. So you can head on over to that website and learn more, or schedule a call with us. We look forward to working with you. See ya.